Hello and welcome. So I'm on page 41 here of your course pack, and what I want to do in this lecture video is I want to spend some time on this problem 159 and this problem 176 on page 43. Okay, so what I'm going to do is I'm going to do the first three journal entries for you. I'm going to show you how to do them, and then I'm going to ask you to pause the lecture video and do the remainder ones and then come back and check it, okay? So let's look at the first one. It says, actually I'll do it through the fourth. I'll do the first four. So the first one, and this is Leonard Matson, and he has his own company. He's completed he's had several different transactions during December of the current year, and what we need to do is prepare journal entries to record these transactions, okay? So we'll come over here and we'll see on 12.1, it says, began a financial services practice by investing $15,000 cash and office equipment that is a $5,000 value. The key word here is investing. What is the investing? Cash, which is an asset, and office equipment, which is also an asset. So our cash is going up, and our office equipment, which is also an asset, is also going up. How do I recognize, and I'll come back over here and draw out my accounting equation, that an asset increases, right? The way I recognize that an asset is going up is with the debit. So I'm going to put down my date, and I will debit cash for my $15,000, and I will debit, and it says also office equipment, so office equipment, which is also an asset, debit office equipment for $5,000. So that's on the debit side. Now we know that debits have to equal credits, so I'm missing a credit. I have to credit something. What do I credit? Well, look at the key term, investing. That means owner's capital. That's what that's telling you. So where do we put owner's capital? Remember, owner's capital influences equity. As in increase in owner's capital, that's what's going on, because it's an increase in owner investment, which means an increase in owner's capital. The way that we recognize an increase in owner's capital is with a credit. Why? Because as owner's capital increases, equity increases. Okay? So then we would then credit L. Matson, because of Leonard Matson, capital for $20,000. Okay? For the summation of those two. So the next one on 12.2, it says we purchased $1,200 of office equipment on credit. Well, where do we put office equipment? You can see that keyword. That is an asset. Okay? And this term means on credit. It means we didn't pay for it yet. We haven't paid for it with cash. This means accounts payable. Where do we put accounts payable? Liability. So office equipment, which is an asset, is going up. How do I increase an asset? With a debit. Okay. And then on credit means accounts payable. Accounts payable is going up. How do I increase in accounts payable is a liability? How do I increase a liability with a credit? So I will debit office equipment for $1,200, and then I will credit, and I'll just write AP, which is short for accounts payable, $1,200. Okay? I'll come over here and have to get a new sheet of paper. So on 12.3, it says we purchased $300 worth of office supplies on credit. Well, where do we put supplies? It's an asset. Assets are going up. I recognize that with the debit. The same term over here, on credit, that means accounts payable. Okay? That means liability. Accounts payable is a liability. My liabilities are going up. So how do I do this with my journal entry? I will debit office supplies for my $300, and then I will credit AP, accounts payable, for my $300. Okay? Then I come over here on 12.4. Look at that one on 12.4. It says I completed work for a client and then immediately received payment of $900 cash. So let's think about that in terms of what's going on with the accounting equation. So I'm getting cash. Cash is an asset. I recognize that with the debit. I completed work for a client, which think about what that means. It means I made a sale. It means I've generated revenue. Where does revenue fit in terms of the accounting equation? Remember, revenue increases equity. And how do I recognize an increase in equity with a credit? So I will credit revenue, but rather than just crediting revenue, I'm going to credit a specific revenue account called fees earned. So I'll come over here, I'm going to debit cash for $900, and then I will credit fees earned. Okay? Now let me just jump ahead to the 14th right over here. This is a prepaid insurance. Okay, that's what that is on the 14th. I just wanted to give you a heads up with that one. That one's a little tricky. So that is prepaid insurance. Okay, so the rest of these I think you can do. And so I want you to give it a try, and then we will go ahead and come back, pause the lecture video, give it a try, and then restart the lecture video, and then let's walk through and check it together, okay? Thanks so much. All right, so let's see how you did. So it says here on the 8th, completed work on credit. Now what that means, right, is I've completed work, so I've generated revenue. So we know we are going to credit fees earned, just like we did on the prior problem, right? But it says I completed it on credit. That means I've completed it and I can recognize the revenue, but I haven't gotten paid yet. So I'm waiting to get paid for work I have completed. That is accounts receivable. So I debit accounts receivable $1,700, credit fees earned $1,700. On the 10th, it said paid for the supplies purchased on credit from December 3rd. So I paid for those office supplies. So whenever you see the term paid, what that means is right away is cash is going down. And how do we recognize that cash is going down? Remember, cash is an asset. How do I decrease an asset with a credit? Accounts payable, so I'm paying off that accounts payable. That's what it's saying. Paid for the supplies purchased on December 3rd. Remember, on December 3rd, we debited supplies and we credited accounts payable. So what I'm doing is I'm paying off my credit card, basically. So I'm paying off my accounts payable. So my liability, accounts payable, is going down. How do I recognize that? With a debit. So I will debit accounts payable. What am I paying with that with? Cash. Cash is going down. Cash is an asset. How to recognize that an asset is decreasing with a credit. So debit accounts payable, credit cash. Okay. I already told you the 14th, you debit prepaid insurance. And then anytime it says paid, that means credit to cash. So I'm going to credit cash. So on the 18th, it says received payment in full for the work completed on December 8th. So on December 8th, remember, we debited accounts receivable, credit fees earned. So now we're getting paid for that. We're getting paid for that. So we're getting paid. That means cash is going up. Cash is going up, right? How do I recognize that cash is going up? Well, cash is an asset. How do I recognize that an asset is increasing? Is with the debit. But I don't have that accounts receivable anymore because I've been paid. So my accounts receivable is going down. Accounts receivable is also an asset, but that asset, accounts receivable, is going down. How do I recognize that in terms of debits and credits? With a credit. So my journal entry is debit to cash, credit accounts receivable. Okay? We look at the next one on the 27th. Leonard withdrew $650 cash from the practice to pay for personal expenses. Withdrew cash. That means cash is going down. So right away, you know you have to credit cash. Withdrew. That means withdrawal. How do I recognize owner withdrawals? With a debit. Why? Because owner's withdrawals decrease equity. And how do I decrease equity? With the debit. So the right answer, debit owner's withdrawals, credit to cash. Okay? On the 30th, paid cash for December utility bills. This is an expense, utility expense. This is a cost of doing business. So I'm recognizing that utilities expense is going up and I'm paying it. How do I pay? Whenever I see something that says paid, that means credit to cash because cash is going down. So I'm recognizing expense, utilities expense is going up. How do I recognize that expense is going up in terms of debits and credits? With a debit. Why? Because as expenses go up, equity, E stands for equity, equity goes down. So I recognize an expense with the debit. So the right answer for the 30th is debit utilities expense, credit to cash, right over here, 175. And then on the last one, received $2,000 from a client for financial services to be rendered next year. Now this one's a tricky one. Congratulations if you got it right. We've talked about this some, okay, but we haven't done the journal entry for it yet. But it would be interesting to see if you got this, if you are able to think through this one. Well, I'm getting cash up front. That's what it's telling you. I'm getting cash. Where do we put cash? It's an asset. How do I increase an asset with the debit? So I know I'm going to debit cash. Now I'm getting paid up front. Remember, we've talked about that. That's unearned revenue. That's unearned revenue. Where do we put unearned revenue in terms of the accounting equation? It's a liability. So my liabilities are also increasing. And how do I increase the liability with a credit? So my journal entry, debit cash, credit unearned revenue. I called it unearned fees. If you called it unearned revenue, that's fine. $2,000 right there. Okay. So that is the rest of those journal entries, and I hope you got all those right. Okay. So now let's come over here and let's look at 176. And I want you to go ahead and pause the lecture video if you have not done this. Okay. So I'm just going to hit pause. I'll come back and let me just comment on this one. What you need to do is do the income statement and then the balance sheet and the statement of owner's equity. Look back in your notes for the format for the income statement, statement of owner's equity, and the balance sheet, and how I went through that using those using these values in the trial balance. Remember, you have to do the income statement first, then the statement of owner's equity, and then the balance sheet. So go ahead and give it a try, and then let's check your work. Okay, so let's see how you did. So your income statement, you have your services revenue right there. Remember, income statement shows revenues and expenses. You have your services revenue, and then you pull all of your expenses here from the trial balance, and you list them down. You subtract the revenues minus total expenses, gives us net income. That's the first one you should have done. Just like I said, do the income statement first. Why do you do the income statement first? Because you need to know net income or net loss to do the statement of owner's equity. The statement of owner's equity is next. And then what we're saying is we had our beginning balance right over here, $39,525. That's given to us right there, plus our net income. And then we subtract out our withdrawals of $36,000. And then that gives us our ending balance in capital, $71,900. Then we go on to do the balance sheet. And look, we have our cash, accounts receivable, supplies, repair shop equipment, and service truck. We add those together, we get total assets right there. And then we are pulling in our accounts payable, which is our only liability, plus our equity, which is our owner's capital, $71,900. We can add those two, gives us total liabilities and equity of $74,500 right there. And then that balances to our total assets. Let me just go back through and make sure you understand where I got these asset numbers from. Cash, right up here, accounts receivable, supplies, repair shop, and then service truck, all the way down straight right there. Okay? So hopefully you got those right. And that's the end of this lecture video. And please reach out to me if you have any questions. Thank you so much.